All right, what's up, boys? Welcome to the channel. Today, we're going to be going over the London session strategy that happens almost every single week between midnight and the 5 o'clock open in terms of New York time, right? So all the times that we're going to be mentioning on this channel is in reference with the New York time zone, right? So the Eastern time, right? So between midnight and 5 a.m. every day, most days of the week, right? If you're looking at pairs, specifically the euro dollar and the pound dollar, you're going to see that the high of day or the low of day is going to form depending on the bias, right? So if we are bullish and we're expecting a bullish expansion for the day, for that daily candle, you're going to see that the high of the day is going to, if we are bullish, we're going to see that the low of the day is going to be formed between midnight and 5 o'clock a.m. New York time. And if we are bearish, you're going to see the same thing, just the opposite, that the high of day is going to be formed between midnight and the 5 o'clock hour, right? So you're going to be looking at that, and basically you're just going to be looking for very easy low-hanging fruits like the Asia sell-side liquidity or the previous day's low, right? So or any sort of discount imbalances. That's if you're selling the market, you're going to be looking for these sort of areas as the draw liquidity. And if you're bullish, you're going to be looking at the Asians buy side liquidity. Let me rename this. You're going to be looking at the Asian buy side liquidity or the previous day's buy side liquidity or any other kind of premium imbalances inside of the premium market, obviously, right? So this is just the schematic of it. And right now we're going to go and we're going to discuss with the candlesticks, right? Because this is just easy work. The drawings are simple, but the actual application, that's where the real work comes in, right? All right, boys. So you can see for the first example here, the price opens at the midnight here, which is denoted by these black vertical lines, right? I have an indicator that plots it. It plots all the midnight openings. But if you are trying to do it manually, you want to be plotting, say, the last 3 days. So, for example, today is the 14th of, not today, but the day we're looking at is the 14th of November, right? So you want to be plotting out the last 3 days, which is going to be Thursday, Wednesday, Tuesday, right? If it was Thursday you're looking at, you're going to be plotting out Wednesday, Tuesday, Monday, right? So basically that's just what it is. But you want to be plotting out that last 3 days because there's going to be some sort of market maker or some buy program forming within that range, right? So it's going to be within that range. If it's not, then it's really a very, very expansive market, and it's one of those type of movements where you should have already be positioned in and be riding that impulsive expansion, because it's very difficult to chase the market when it's just extremely bullish. You can't really go and place yourself unless you're scalping. It's very difficult to engage these sort of markets because the market is just hanging in a deep premium, and it's not really giving you that retracement into a discount to buy. So you have to just scalp, and if you're not a scalper, then you don't trade those markets, and you look at other markets that can be traded or are moving appropriately, right? So we're looking at the pound dollar for today, not today but Friday 14th, which is basically the schematic. You can see here price opens at midnight, opens, and it drops immediately down into this discount imbalance. So if you're looking at the range between the high and the low of the previous day from midnight to midnight, as always, which is what you want to be looking at, because the midnight, that's what starts the financial financial day, midnight New York, because the United States is the dollar is the reserve currency of the world. So everything is based on the dollar, right? So you want to be looking at that midnight opening, and you can see price opens, trades up, does not take out. If you're looking at 7 o'clock p.m. all the way to midnight, which is where you're going to be looking at for that Asian range, that flout, that liquidity buildup, from 7 p.m. all the way to midnight, you can see that the high and the low is here. Price opens at midnight and drops down, taking out the sell side into what exactly? This discount imbalance. So price drops into the discount, as we have already been bullish on the day. We're expecting some kind of bullish expansion for today. So as price drops into the discount, you want to be buying that, expecting that the low of the day is not going to be reached. You understand? So you buy this, right here around 2 o'clock, which is inside of that midnight to 5 o'clock. The low of day is going to be formed in there. You can buy that and then you can ride it for what I told you. You want to be looking at the Asian buy side liquidity, which is going to be the price point, the highest price point between 7 p.m. and midnight, which is this price point here. You want to be identifying that and you want to mark that as your draw. And then you're looking at any other sort of premium arrays in here. You have the previous day's high, but before we get to the previous day's high, we have this imbalance here. We have these imbalance here and this one here as well, right? But I'm thinking, if I'm going to be buying here and I'm expecting a bullish expansion, this looks much more like the point price wants to get to. That you can take partials here. You know, if price gets into there, you can take partials here. But if you're looking at the risk reward on that, it's about 1.6, which is fine. For me, the minimum I will take or try to engage trade is 1.5 R. That's the minimum risk reward I would look for in my trade. So this is valid. So you can take partials inside of this imbalance here and looking at this imbalance here. I actually traded this market. You can go check out my Twitter where I post these trade insights when I have them. I actually traded this market and I ended up holding for the full position inside of this imbalance right here, right? So I held a little bit of a partial looking to see if we could take out this previous day's high, but about 20% of the position, but about more than 85% was closed inside of this premium imbalance here, right? So this is one example. All right, so you can see over here again on the euro dollar on the very same day, we had price expand from midnight. If you want to draw the midnight opening here, which I did not put, yeah, you can see from midnight, the price opens, trades up, takes out the Asian buy side liquidity into this imbalance right here. So if you're going to hourly chart, you can see it very much clearly here. Price opens, trades up into that premium imbalance, runs the buy side liquidity. You can go long there, right? So if you take your Fibonacci, which if you want to use Fibonacci, you can see that price is trading nicely inside of the upper level, which is the 0.79% level. You can buy that right there. And then you're writing price down, expecting that it's going to draw for discount, right? So when you look at the market move like this, right, we open and we trade into the previous day's range. This low here, someone would be like, well, George, you said when we buy, we should be looking at the previous day's low to be taking out. No, you should not just be looking at that, right? There's a whole lot of other things. That's why you need to be properly versed in terms of like ICT concepts to understand that this low right here is it's trading. It traded into this sell side inefficiency. So this expansion here, there was a inefficiency. So if you draw it right here, there was a selling inefficiency in there. So price with this retracement lower trades into it and it expands. So I'm not expecting that price trades back beneath this level, right? So when I'm seeing, if I'm bearish on the day and I see price trade into this imbalance right here, and I'm expecting a drop, I'm looking at the macro equilibrium, because if you can see, I'm using a very faint color, which is a black, in relation to the the canvas of the chart. So I hope you can see that. But I have let me make it white so you can see it. Right, this is the previous day's range. So you can see price trades down to the equilibrium price point, which is what I was looking for on this day. I didn't take this trade on the euro. I took the trade on the pound, but I was very well aware of the trade setup here on the euro as well, right? But this is essentially the trade idea that you can take. Buy, you can sell the market short right here, stop here above the previous day's high, expecting that we're not going to take it out because of the imbalance and we are bearish on the day. And this is a very low hanging fruit. You can see the Asian low, which was not taking out. We bought here, and then you can exit right here, and then you can look to exit your full position over here. And you can see price returns back into that inefficiency that was balanced with this move, and it fails to trade below the low here, not until over here after it had stopped out anyone who would have gone short here, right? Because if you had gone short here, even if your stop was over here and you saw price trade all the way down here, you certainly have trailed your stops to inside of the move, because you're not expecting price returning all the way up here. So anyone that was short here, unless you're a very, very strict trader in terms of your, because you're not going to be seeing price here and seeing all this movement, this huge bullish expansion, and still hold onto your position thinking that, you know, this is going to hold, right? So most people will be stopped out here, exit the positions, and price will use that liquidity, and you can see it used to reprice here. So this was a low resistance liquidity run down beneath this level to the market equilibrium, but it was a high resistance liquidity run trying to trade beneath this level, which is the intermediate term low, which ICT states that when you see an intermediate term low form or an intermediate term high, price is not just going to easily trade through those areas, right? So you can see how that came all the way back here, and then before it shut down again, right? It shut down here, a bit of sensitivity, and it shut down now, traded below the low, right? So you want to be careful in these sort of instances, right? All right, boys, so you can see we have another example here. You can see from the midnight opening, price trades all the way up into the imbalance from the previous day, as we are bearish on the day. And over here, you can see why I emphasize in the beginning of the video why you need to be plotting out the last 3 days, the highs and the lows of the last 3 days. Because if you look at today, which is on the Wednesday the 12th, not today, but the day we're looking at, Wednesday the 12th of November, you can see 1, 2, 3. This day here, this is the low of the day, and you can see price is in a sell model. So if you look at all this is just a market maker sell model. From here, smart money reversal, this is your first stage. Second stage right here, this is the move, this is the drop right here, right? So you can see why you need to be plotting out these levels. You don't just want to be looking at the previous day low, right? You want to be looking the last 3 days to see if there's any sell side liquidity resting there, because price more than likely is going to want to draw to them levels, right? So you can see price opens straight up into there, and this setup this day here, which I also indeed traded, had 2 different setups. So there's another setup here, which is going to be that New York continuation play out, which we're going to talk about in the next video. But you can see as price trades into here, you can't just buy long, you can't just sell short here unless you're the type of trader who, you know, you don't really care about risk to reward, and then you're fine with that. You can buy it, but then your stop is going to have to be above this price point here, right? So if you're not prepared for that, you have to go into the lower time frame and try to get a trade on you have to sell on a stop. So I went on the 15, and once price traded beneath these candles, so you can see these last 2 series of down close candles. I'm just specifically looking at this last one because this candle here failed to close. You can see the body failed to close above this previous candles range. So I was just looking at this one here, and once we traded beneath the opening price of that, I went short there, right there, right? And then I was looking at the external range liquidity from the last 3 days. I was looking for that to be reached for, right? So you can see as price delivered exquisitely for that price point here, which is the New York continuation play out. But we're not going to be talking about it in today's video. We're going to leave it for another day, right? Which is essentially the same idea of the London, but you're just getting the continuation play out in the New York session. It's that you have the bias. If you fail to get London, if you fail to engage, if you fail to be able to participate in that London expansion, you're going to wait to see if London sold off. If you're bearish on the day, you want to see London sell off, and you want to see New York trade into a optimal trade entry, and then you're selling that. But we're going to do a much more detailed breakdown on the New York continuation play out. And then, yeah, so this is pretty much examples, enough examples for you to see to go and backtest on. You want to backtest these examples and then record the data, and then you'll be convinced. You don't want to take my word for it, because some people will be like, oh, I've just selected, you know, very specific dates. This is all within the course of the last weeks, right? If it's not going to be the London session move like this, is going to be in the New York session play out. So it's going to be one of the other, or there's no setup. Because it's either going to have to, if it's going to be a sell day, it's either that the London is going to make the high of the day, or you're going to get the New York continuation play out. One of them, or the third will be, it just makes the high of the day in London and it just expands and leaves you, right? So sometimes it can just happen where you're bearish on the day, London trades into a premium array, you're waiting for a entry, or doesn't give you a desired entry, and it just drops and leaves you. And there's days where that would happen, and it's like you can't do anything about it, right? So yeah, that's pretty much it. So yeah, I hope you guys like the video. Like and subscribe, because we're going to be dropping videos like this every other week. Yeah, have a nice day and good trading.